Earlier this week, President Joe Biden unveiling his $2 trillion infrastructure plan. Joining me to talk about the road to recovery today is Brent Johnson. He's the CEO and founder of Santiago Capital. Brent, welcome to StansberryInvestor.com. Good to see you.
Thank you for having me. Looking forward to speaking with you today.
Yeah, we're going to dissect a lot of topics here, but let's start with the economic road to recovery. Looks like a long one, and some big numbers being thrown around here. $2 trillion infrastructure plan. What do you make of it, Brett? And what does the recovery look like to you?
Well, it's really kind of interesting because when we've gotten so used to using billions, and then we had to switch to trillions, and when we started saying trillions, wow, that's a big number, and now we throw around trillions like it's no big deal. But it's a huge number. I mean, 2 trillion is 10% of US GDP, right? And if we do that this won't be the last stimulus plan. There will be another one, and then there'll be a follow-on to the infrastructure plan. And the numbers are just really incredible, so you can't ignore them. That said, I don't think the economic road to recovery will be as smooth as the markets are forecasting them to be. I think this global reflation trade and the global growth trade has gotten a little bit ahead of itself. I'm in client portfolios, we've been long equities reluctantly, so we do still have exposure, but I think it would be fairly easy to have some kind of a pullback or a correction just to kind of, let a little pressure out of the bubble, so to speak.
Brent, you have famously said, in the past that debt has major consequences, and the central banks right now are doing their best to push those consequences down the road. But at some point, something has to give, right?
That's right. Yeah, and my whole outlook on the world is really based on debt. I mean, it really is, because the debts have gotten so big that I think that there's going to be a reckoning day. Now, here's the interesting thing is you can go back to 1982 or 86 or 89 or 99 or 2007 or 2013, and you can find people saying the exact same thing. So the whole, inevitable and imminent are not the same thing, right? I believe there will be consequences, and I think we're getting closer to that reckoning day than maybe perhaps some others do. But I don't know whether it's going to happen tomorrow or if it's going to happen 2 years from now. But I have, my job as a fiduciary for my clients is to be prepared for everything. And I think that the debts in the world are going to have consequences.
And I want to get back to, how you manage people's wealth and best places to be in a second. But just looking at this infrastructure plan, which obviously will benefit, manufacturing, transportation. There's always going to be winners and losers here. So I want to ask you, Brett, like who wins, who loses, and what sectors should we be eyeing?
It's a very good question. I actually tend to think, again, because I think the global growth story is not as good as everybody else, and because I think the reflation trade is a little overdone, I am not as on board with the whole emerging markets and commodities trade as a lot of other people. Now, obviously, if we get, as part of an infrastructure plan, there's going to be commodities are going to be needed, right? And so I get that part of it. But I think the broader economy is not nearly as healthy as the stock market is reflecting. I live in San Francisco, and it's a big restaurant town, and I have a number of friends who own restaurants, and they're surviving, but barely. But people that work in sports arenas and the work in bus stations and some of these more low income jobs, I mean, they're really hurting, and a lot of those jobs aren't coming back. So I'm not convinced that GDP is going to grow at the extent that, or global, I should say global GDP. I think the U.S. will grow faster than the rest of the world, but I don't think we're going into this new credit cycle where we've got 3 or 4 years of runaway growth.
What about the narrative, though, and the push towards clean technology, though, Brett? And, we got to rush into copper, we got to rush into silver, rush into the battery metals. Do you buy that?
Well, it's an interesting question because I do, but I think it's artificial. And let me tell you what I mean by that. Is I don't think the market, again, I know I keep saying the same thing over and over, but I don't think the market is healthy I don't think the economy is as healthy as the market is showing, but because the governments will force things into green energy, and we've got this, build back better policy, they will mandate that these industries get funds. So I think it's important to have exposure to those areas, but I don't think you should go all in on that trade because, again, just because the government's mandating it, I don't necessarily think it's going to work, if that makes sense. But I do think it's important to have your eye on it, maybe have some exposure, but I'm never an all or nothing guy. I don't think you just throw everything out and you go 100% into green energy because, you know, that's the next thing.
You are also the creator behind the dollar milkshake theory. Sounds like a whipped up drink of deliciousness, but not really so. There's a lot of facets to the theory, and I'll let you explain it much better than I can. But basically, it predicts a bull market in the US dollar, but with a huge caveat.
That's right. And so, you know, I started talking about this a couple of years ago. And again, as part of my job, I've got to look out there and figure out what are all the possibilities, but what could potentially go wrong. And I think the biggest risk to the world is a rising dollar. Now, the whole world thinks that the dollar is going to get weaker. You know, the whole money printer go burr meme. You know, we're doing infrastructure plans, we're doing stimulus plans, we're going to do more. The Fed's buying all the bonds, it's QE after QE, automatically the dollar falls, right? And everybody's on board with that trade. And I just think it's wrong. I don't think that that's necessarily how it's going to play out. And the reason is because on an absolute basis versus some commodities, versus gold, versus Bitcoin, versus some other hard asset, the dollar might fall. But fiat currencies trade relative to each other. And Europe has to do the same thing. I mean, look, Christine Lagarde came out today and basically echoed Draghi's comments that, you know, you can try to take us on if you want, but we're going to do whatever it takes. Japan has to do the same thing. China is going to have to do the same thing. Australia has already upped their bond purchases. So it's you know, it's not like if the US was doing all this stuff in a vacuum and everybody else was in great fiscal shape, then absolutely the dollar would lose value. But the whole world is kind of in the same place. Everybody has to stimulate, everybody has to quote unquote print money. And, you know, when I look back 12 years ago at the global financial crisis, the Fed came out first and did QE and, you know, did it pretty aggressively, and the dollar fell 10%. But then everybody else kind of got involved as well. And the dollar never went lower after that. Despite 10 years of stimulus and 10 years of plans and 10 years of QE, the dollar went up 20% versus other fiat currencies. And that's the same thing's kind of happened again now. You know, the US came out last year quicker and faster than everybody else. The dollar pulled back about 10%. But despite a blue wave in Congress and the president of the United States, despite multiple stimulus plans, despite this $2 trillion, you know, infrastructure plan, you know, the dollar has risen. It started to bounce from that level. And now these other countries are starting to have to increase their bond purchases. So to me, it's not a given. And, you know, going back to the dollar milkshake theory, the point that I like to make is that despite there's been a lot of opposition to the dollar, a lot of people around the world would view the US as a bully. You know, we've kind of pushed our view on other people. We've forced them to use our currency. And there's some truth to that. I won't deny it. And perhaps those countries would like to stop using the dollar, but wanting to do something and being able to do something are two very different things. And a lot of the rest of the world owes all this dollar debt. So whether they want to or not, they need dollars just to service the debt and to trade with the United States. And so I think that puts an automatic bid under the dollar.
So what does that mean for gold? Because the narrative that gold bugs, as you know, Brent, like to use is the dollar's being devalued, and there's going to be a rush into assets like gold.
Yeah. So short term, medium term, long term. Short term, I'm still not convinced that we're going to have this runaway breakout, you know, in gold. I mean, if you think about the last year, you've pretty much had everything you could have possibly wanted for gold to break out and stay breaking out, right? Crazy money printing, crazy government policies, political uncertainty, revolutionaries in Washington, D.C., and yet gold has fallen off 10% since the summer. So again, it doesn't mean that gold won't. I think it's a critical part of everybody's portfolio, you know, and I believe it will do dramatically well in the years ahead. That doesn't mean it's going to happen over the next couple of months. It actually wouldn't surprise me if we go back to the $1,600, even $1,500 level, you know, over the next, call it 6 or 7 months. I don't know that will happen, but it just would not surprise me. But in the years ahead, you know, part of this milkshake theory is that global capital will get sucked into the United States and sucked into the dollar. That will push the dollar higher. But when that happens, it actually creates chaos around the world. And if the dollar is falling in real terms, but it's just rising versus other fiat currencies, then we can get into a situation where the dollar rises and gold rise together versus everything else. And that's where I think we'll ultimately end up. And that's kind of, and I think the Dow US stocks will go up as well. Now there's going to be corrections along the way, but that's kind of the milkshake theory, is that the dollar, the Dow, and gold all rise together in the years ahead.
Interesting, interesting. Now, and I'm happy you brought up that point of, if there was ever a perfect scenario for gold, because I've asked people this on the show all the time, like, this was like the ultimate black swan. Why wasn't gold responding? And the response I would get, well, look, gold did go to 2000. It did hit an all-time high in this context.
It absolutely did. Yeah. And it's funny because in many ways, I think gold is doing exactly what it's supposed to do. Like when we were having the kind of the chaos and we were having kind of some of this political gridlock and political uncertainty and COVID, gold took off. It's a crisis hedge. It's an insurance hedge. And it did that throughout the crisis and into the fall. But once some of that uncertainty started to get taken out of the market, we've started to get the vaccine news. Biden became president. Global growth started to pick up. You don't need the insurance as much, right? And so, gold has pulled back.
Valid point.
There's one other thing. Let me before I forget. Let me make one point, and because I get this conversation a lot, and a lot of people in the gold world view gold as an inflation hedge, and we've seen this rise in commodities. We've seen all this money printing, quote unquote, and so people feel that's inflationary. Gold should be doing well. That is true with a caveat. I think that there's a range in which the gold doesn't do well. So there's a difference between reflation and inflation. So I kind of feel like if real rates are negative, gold should do very well. If inflation rates are really high, gold should do really well. But there's this middle range, I don't know, call it 0 to 2% inflation, where I don't think gold really does that well. And the reason is because if you're at 0 going to 2, that kind of means things are getting better. Growth is starting to pick up a little bit. Yields are starting to rise a little bit on sovereign bonds. And the natural reaction for the average person in the United States or Canada, around the world, their first thought isn't, let's go buy gold. If things start to get a little bit more expensive, or if things start to get a little bit of inflationary pressure, me and you and some of the other people in the gold community maybe think go buy gold. But that's not the average person's first thought. The average person's first thought is, things are getting a little better, I'll go buy stocks, right? So from the 0 to 2% reflation, things are getting better, why do I need gold? So I can kind of understand gold not doing well. Now, if we break out of that 2% and we start getting 4, 5, 6% inflation, I think gold will do very well. But I think we're kind of still in this reflationary band.
Is the person outside the gold sphere person also thinking, okay, I'll buy stocks and I'll buy Bitcoin, and how much of that is impacting gold?
Well, I don't think that it should impact gold, but I absolutely believe that it has. So, there's this big debate, which should you have, gold or Bitcoin? Which is better, gold or Bitcoin? I personally think it's kind of a silly debate. There's no reason you can't have both. And in fact, I would argue that maybe you should have both. But in my opinion, there's no doubt that Bitcoin has kind of stolen gold's thunder. If Bitcoin did not exist, I think gold would be much higher than it is today, because that would be the primary way that people are, investing for a crisis or inflation or whatever it is. But there's no question that Bitcoin has gobbled up a lot of the dollars that would have gone into gold, in my opinion. So, it's definitely had an impact.
There's a narrative circulating, and maybe you've heard from a lot of popular gold pundits who argue that a lot of popular Bitcoin pundits are purposely bashing gold recently to take more market cap away from gold, and that's because that's the only way Bitcoin can get to those projections out there of 500,000, 1 million.
Yeah, I mean, I think that's just kind of natural. Like anybody who works in a certain industry, your goal is always to grab market share, right? So people in equities want to grab market share from fixed income and Bitcoin and gold, and people in gold want to grab market share from equities and Bitcoin. I don't put much stock into it, to be honest.
Okay. This is the point of the interview I really wanted to get to, Brett.
Okay.
You make a living managing money,
Yeah.
and you famously said, look, a lot of the money managed, the people are not looking to become billionaires, but they're looking for wealth preservation. That's what most
That's
want,
right.
wealth preservation. So where are the best places and assets to be in right now?
Yeah. So again, because I'm a believer that the U.S. will attract a lot of global capital in the years ahead as a result, I think we're going to have this debt crisis and currency crisis, and I think that will attract capital to the United States. So I'm towards U.S. assets, whether it's fixed income, equities, technology, some commodity-based industries, or I like agricultural-based industries. So that would be kind of a way I'd look for growth. I'm always in favor of a diversified portfolio. I think everybody should own gold. Wouldn't hurt for everybody owned a little bit of Bitcoin. I don't think you should go crazy on Bitcoin. But I also, as part of my portfolio management, we have a kind of a volatility overlay or a volatility sleeve that kind of protects against some unexpected things. And so we actually run a fund that should do very well. Should the dollar get stronger and cause this chaos that we foresee, that fund should do very well. Now, in the case that there is no chaos and the dollar doesn't do well, then that hedge won't pay off, but the rest of the portfolio will do very well. So I guess my point is that I think you need to set your portfolio up in a way. If you're trying to preserve wealth, if you're trying to make a fair return and preserve wealth, I think you need to set your portfolio up in a way that kind of prepared for anything. And that means there may be periods of time where you trail the overall market, but there's going to be times where you outperform the overall market. And so I have exposure to equities, mainly U.S. equities. I've avoided emerging markets. We have a little bit of exposure to commodities, but we have not gone all in on this commodity boom. We have some precious metals, and we have some short-term U.S. fixed income.
On the agricultural front, sorry, did you mean like investing in companies like John Deere or actually buying farmland, or how do you do it?
Well, I think there's a few some fertilizer companies and some corporate equities that invest in farms and stuff like that. Okay. Again, I am more bullish on agricultural commodities than I am on industrial commodities.
Okay, gotcha.
Yeah,
gotcha.
yeah.
All right. A really good discussion here, Brett. I guess just final thoughts for investors watching who are trying to make sense of this environment that we're in here. I know you've said don't use the S&P as a benchmark. One.
Right.
Any other advice?
Well, I would just say, I think the big battle, the big debate in my world and the people I talk to is inflation versus deflation. Right. And, all the debts in the world, I believe that is deflationary. Now, the governments are doing everything they possibly can to counteract that. And we've seen this several times over the last 10 or 12 years, and I would argue even over the last 20 or 30 years, where you get these government programs that comes in and provide short-term, and you do get these short-term inflationary impulses. But then they always roll over, and it's because the debt is so big. And so I'm not going to sit here and say I don't see the inflationary pressures. You just look at the prices on your screen, you see prices have gone up over the last year. The question is whether or not it's sustainable, right? And one of the big ways to get sustainable inflation is the banks have to lend new money into existence. And they're just not doing that right now. And so unless the banks start lending that new money into existence, I don't think the inflationary pressures that we're seeing are sustainable. So one thing I would say to investors is, if you're going all in on this inflationary kick, just be careful. Perhaps have a hedge, perhaps have some part of your portfolio to prepare for a deflationary event as well.
So are you using or not using the word transitory as the Fed is saying, that we'll see transitory inflation?
I hate agreeing with the Fed, but in this case, unless the banks kick in and start helping the Fed out, then yes, I think it will be transitory.
Wow.
Yeah.
Brent Johnson agreeing with Jerome Powell.
I hate it.
I got you to say it.
No, don't put that at the headline. Well,
I wouldn't do that.
A big part of it, and we don't have time to go into it right now, but the way QE works is really misunderstood. Everybody calls it money printing. It sort of is. It really isn't. It does have short-term inflationary impacts, but again, unless they get help from the real economy, it's just not sustainable. And so if I see that change, if I see them start to get help from the real economy, then I'll tell Jerome that he's out to lunch and doesn't have a clue.
Fair enough.
Which he is. But anyway.
All right. Brent Johnson, this was a fantastic discussion. I loved it. I hope you did too.
Oh yeah, absolutely. I'm happy to talk to you anytime.
All right. I'm going to go make myself a milkshake now. You made me crave one for some crazy reason. All right.
Perfect.
Come back anytime. StansberryInvestor.com, Brent Johnson, Santiago Capital. And thank you all for watching. We'll have much more for you. So be sure to stay tuned. In the meantime, share us where you watch us. That's it for me. I'm Daniela Cambone.